Welcome, guys. We're joined by the guys from Beta Shares. We've got Cam and Chris from Beta Shares that are going to share some market insights and give us an update about what's happening in the world and some opportunities we might start looking for. So, Cam, I'll throw over to you to give us a quick update on what's happening, and I'll ask some questions as we go along.
Thank you, Matt. Great to be on this recording with everyone here today. We just wanted to give a bit of a set the scene as to how the year 2023 has started. Of course, last year, the real focus was around the rate hiking cycle and whether the US was going to enter into a recession, which colloquially was called a hard landing. Through the back end of last year, that was essentially what markets really were pricing with the level of volatility we saw into December. However, as we entered the start of the new year, we saw, in fact, very buoyant conditions in markets. I show here the price performance in the first column across a range of global indices. And really the start of 2023 started out with quite positive expectations. That was really based on expectations of the market that perhaps we were getting to the end of the hiking cycle. We can see a chart here on the right-hand side showing US interest rates. So Fed funds rate sort of now up towards that 5%. But what's been interesting has been expectations of inflation. So again, up on the right-hand side chart, we see, for example, the orange line and even the core CPI all starting to fall down. Now, the real point around fear around markets has been whether or not the US Fed would need to hike cash rates in the US to the point where the US fell into a recession. These ticks down in inflation data gave people hope that, in fact, they weren't going to need to do that. They weren't going to need to cause a recession. We're going to have what's known as a soft landing. And as a result, January was really a rally in everything. Equities were up, bonds were up, bond yields were compressed, so bonds were up. The only thing that sold off was the US dollar. So it was very sort of a risk-on environment. Now, I guess that sort of brings us to sort of where we see the market and where we think things are sort of placed. Our outlook for 2023 is that we think there's possibly three real scenarios that are actually relatively likely, and they're shown here in this chart. We still believe that the most likely outcome is that US recession, that the Fed's rate hikes were going to be enough to push the US into recession, and we can talk a bit about why that is. We attach about a 50% probability at this stage to that occurring. The second most likely outcome, we believe, is a soft landing for the US economy. Somehow, like markets have sort of led themselves to believe in January, the Fed's able to engineer a way out of a recession while still containing inflation, and we end up in this sort of Goldilocks zone. The third other scenario, which is perhaps a continuation of the last year, is that sort of stagflation environment. No real landing, we sort of muddle our way through, and they've assigned a lower weight to that, 15% weight to that in terms of our outlook. I mean, just thinking a little bit about these three main scenarios, that US recession, that hard landing scenario. I guess, the thing that concerns us perhaps most about that is, the US at the moment, inflation's coming down, but they still seem to have an issue with wage price growth and the amount of pressure in the labour market. It's something we just don't see the same degree in Australia. On Friday, you will have noted that the US put on another 500,000 workers when expectations were for a far lower figure. So there's still a lot of pressure on wages, and the fear there is that if wage price increases, then you tend to get basically inflation embedding across the economy, because wages are a major part of the cost base for the provision of services, and services make up more than 50% of CPI. So that's the real concern. Is wage price there going to get embedded? Can the Fed engineer a way out of that? In terms of that hard landing scenario,
are we starting to see? Sorry, Cam. Are we starting to see some of those employment figures change? Like, we've seen a lot of the tech companies start to make redundancies. Like, I don't know whether they've pulled the trigger early. They can see what's coming, and a lot of other industries haven't jumped yet, or they haven't seen what's coming.
Yeah, that's right. Look, I mean, looking across the earnings results of Q4, the US earnings season, the cost cutting really, sort of, there were other companies like Dow Chemicals and alike that were cutting costs, but it was predominantly, within the tech sector where they've seen this sort of, outsized growth post-COVID and perhaps, pulled on too many workers, and now they're adjusting back down to a more normal level of growth. Unemployment there is now dropped marginally to 3.4%, so very low levels of unemployment. And thus far, although I've seen a few surveys indicating that wage price growth was perhaps growing a little bit slower, it still seems that there is a fair degree of pressure in the employment market.
Yep.
That's what we're really grappling with. In terms of how equity markets are priced, I guess the real problem that we've seen and has really been the valuations that we now ascribe to US equities. So the price to earnings ratio, the valuation multiple that we generally use is a ratio of next year's earnings divided by current price. That earnings yield, or the price to earnings ratio, if we invert it, is around about 18 and 18.5, nearly 19 now. That's a level where you would say the market's pricing in at least a soft landing. The market's pricing in, a good outcome, particularly when we see the direction of consensus earnings forecasts over the next couple of years. So not necessarily in the short term, but looking further out, markets, the consensus forecasts of a 9% earnings growth sort of year on year for the following 2 years. And where we see, that looking, relatively aggressive is that in a recession, you typically see that corporates' profit margins come under pressure. This here shows the profit margins of the US S&P 500 index over a long period of time. And so, typically profit margins of corporates are level between about 8% and 10% during most of the market cycle. But almost invariably in these dark gray patches in US recessions, you see a compression of profit margins. Companies don't have the same pricing power when demand is taken out of the system. And so they've really got to, discount prices in order to move inventory. We've had this very elevated level of profit margins here post-COVID. You can see up to 13%. That's starting to come down. And so we think that earnings growth rate is going to come under pressure, frankly, regardless as to whether or not we have a recession or not. And so that's where the real challenge lays in terms of US equities. We may have a hard landing, might have a soft landing. There'll be degrees there. The degree of the recession may not be that deep, but even if it is a shallow recession, pressure will still remain on the earnings growth that's priced in.
Yeah, and again, one of the things that we always sort of talk to, especially when David Bassanese, our chief economist, looks at these data and what the Fed is trying to engineer in terms of that soft landing, is the fact that they've never been able to do that historically. So bring the economy down from these levels of inflation without actually having to pull the US economy into recession. So if they do it, it'd be something that is very much, something that hasn't been done before.
Yeah, so we can sort of see what's priced into fixed income markets, which is often kind of interesting. In terms of both Australia and the US, the expectations are that there's about 2 more cash rate hikes in this particular cycle. Now, if we look at those fixed income markets, so we're expecting, one in about March, a rate hike in March of 25 basis points in the States, and again in about May. But then at the back end of 2023, fixed income markets are actually starting to price in cuts, and then pretty substantial cuts after that. That's all predicated on a recessionary outlook, on the likelihood that essentially the Fed will be forced to cut rates in order to really prop up the economy.
Do equity markets reflect that as well?
Look, it sort of depends on your viewpoint there. I would say that in terms of valuations, that the current PEs are probably about fair if you think that earnings growth is about right. The issue, I think, is that the forecast earnings growth is too high. So if we do go into a recession, these PE ratios are going to be, too high. And we're going to see the earnings drop away. Typically speaking, in a recession, your PE ratio might fall to between about 10 and 14, depending on the discount rate or the risk-free rate at the time and how deep the recession is. So I think either way, that the market's not pricing in that recession, regardless as to whether or not the fixed income market's pricing in the recession at the second half of the year.
You also had a really good example of the different research houses in terms of their views of forward pricing between was it Goldman Sachs and Morgan Stanley, was it?
Yeah, Morgan Stanley. Yeah, so I mean there is a range of views, and the majority of strategists out there towards the back end of last year were still focused on their base case being a US recession. A few shops have started to change their view there and said, look, perhaps we will have a soft landing. There's no longer a sort of consensus around that US recession. But even those that do believe that we are in for a soft landing, do caveat that with the issues that we see on this screen about the current elevated profit margins looking like they're going to come under pressure. So even those that believe that the general economy will weather this period of uncertainty, they don't necessarily see a lot of upside in the equity market.
Perfect. Thanks, Cam. I think that's good to note as well, because we've got some nervous clients looking at what happened last year, listening to the media around now, looking at the outlook, saying, hey, there probably is a bit of uncertainty coming in the next 6 to 12 months that we need to weather and need to think about different portfolios and things like that.
Yeah, you would say that, look, there's a fair probability that in the month of January, the market got a bit ahead of itself.
A bit too optimistic?
In terms of how far it ran. Time will tell whether that view is correct, of course. But that would be my read looking at the data.
Perfect.
And so, I mean, if you want to talk a little bit about the Australian economy itself, I mean, if we think about the Australian equity market generally, it's important to differentiate between the economy and the equity market. Our equity market really is a market, made of cyclical names, miners and banks. And the performance of our equity market tends to move in lockstep with the US equity market. We're a very outward-looking equity market, if you like. Global growth defines the fortunes of the likes of BHP. I probably bifurcate between equities and the Australian real economy. Our economy, while inflation is, and we can sort of show that here, probably peaking, sort of right now or in the December quarter, we see how high, sort of CPI sort of show up in the December quarter. We certainly don't seem to have the same issue with embedded wage price growth that the States has. And that gives us a lot of comfort. We also know that the fact that our mortgage market is dominated by variable rate mortgages and there's a lagged effect. We think that the levers that the RBA has already pulled are going to see these CPI figures calm down. And without that embedded wage price problem, frankly, we think the Australian economy is in a much better position. And frankly, our GDP growth in December quarter looked pretty strong. So the real economy might sort of muddle its way through this quite well, albeit financial assets like equities will somewhat be at the hands of what happens offshore.
Yeah, and taking into account the rate hikes that we're speaking about, possibly, what are we looking at Australia? You mentioned possibly 2 more in the US. Are we thinking similar in Australia as well?
Yeah, that's right. Likely 2 more. I have seen a few people sort of increasing their peak cash rate to sort of above that, but ourselves, the market, and most would suggest 2 more. A lot of the heavy lifting has already been done. It's about the RBA really monitoring that, slowing down, and seeing how this feeds through the system.
So giving it the time for everyone to start feeling the effects of it, the data to flow through.
That's right. They're Debbie Head from their economics department of the RBA came out last week saying that they were expecting 800,000 fixed rate loans to roll off this year, to give you any indication.
The
Now,
mortgage cliff, which
Yeah,
the
that's
media
right.
keeps telling everyone about.
That's right. That's right. That doesn't necessarily mean 800,000 houses, because often a house can have more than one fixed rate loan. But you know, clearly they're cognizant of that. Property is, a huge component of economic growth, and I think there will be some hesitancy to push too hard when we know how important that is. If we look at the Australian consumer, in aggregate, we're still relatively cashed up. The household savings rate, which tells the proportion of income household saved, that started to fall. It's just below 10% as of September quarter, but it's still higher than where it was pre-COVID.
Yeah.
I guess the key point there, though, is these aggregate numbers, they really sort of disguise the fact that you've got, people in very different situations. Someone who owns their own house with no mortgage is probably not feeling much inflationary pressure right now. Someone who's got a mortgage, perhaps in a younger cohort, their discretionary spending, which is a relatively high share of overall consumption in Australia, that's where we're going to see a lot more pressure, is in those sorts of groups and those demographics.
And that's going to continue to put downward pressure on property prices moving forward for this next 6 to 12 months.
Yeah, so property, look, I don't know. I don't profess to be to have a crystal ball.
Yeah.
Not Chris Joy. But look, I mean, I would say this: it's quite expensive to build a house. It's quite expensive if you want to do a renovation right now. There's not a lot of stock in the market. I don't want to say I'm a property bull, but we do have less dwellings per capita than a lot of other developed market economies, and we've now got inflation coming back in. Basically, inflation taps were shut off during COVID, and now we're expecting much greater degree of population growth in this tax year or fiscal year. So I guess I sort of feel like there is a bit of a floor in terms of property, unless we get very high or elevated unemployment. And the fact that we've only got, say, 2 rate hikes left, leads me to think that without a severe economic downturn and unemployment, there's some level of support for property. I wouldn't say it's bullish, but neither do I think that we're likely to see a crash in the Australian residential property market.
Perfect. What else did you want to touch on, Cam? I think we've hit
whatever you like.
We've hit a lot of the main ones that I wanted to discuss. The equities market, rate hikes, mortgage holders.
I guess, we could sort of talk a bit about in inflation factors, if you like, if that's of interest to you, or like
probably more the uncertainty and
Yeah.
what you're seeing from your end and advising beta shares advisors and clients around being more defensive for this next little bit. What are you really looking at there?
Yeah. So I guess when we sort of think about, the outlook, there is still a fair degree of uncertainty. There's a few risks that inflation could also be more persistent. We've started to see signs of economic growth in Europe. The winter they had there was less harsh than was feared, which sort of in aggregate is a good thing for the health of their economies. China is reopening, and China is a large consumer of commodities, and particularly oil, for example. These things could feed into further inflation and lead to more uncertainty in both the Fed's hiking cycle, but then also equities as a result. So there's still some risk factors out there around inflation. I don't think we should just assume that these paths downward that we see on screen, that those trajectories are a given that they'll continue. And really, when looking at this from an Australian perspective, the key to a lot of this inflation has been demand. Europe and China probably add marginal demand, but the key is what's happening to the US consumer. They really drive, global demand. Their consumption in the US economy is is the real driver. So it's looking to the US for a lead there. But also just acknowledging there are some risk factors that might lead to a rockier path down in inflation than perhaps some people are hoping.
Perfect. I think that pretty much wraps it up, Cam. I think that's pretty much everything I wanted to cover, mate.
Right.
I think you provided some very good insights about what's happening out there at the moment, what's the outlook look like for equities, inflation, rate hikes, property markets. And I think it's a really good summary for a lot of our clients to just sit back and actually absorb all that information, take it in and see how it really affects them and their situation. I think also there's a lot of noise out there at the moment, and I think that's going to intensify over the next couple of months, as the media likes to do. So I think it's good to hear from a source rather than with all this data backing it, rather than the news at 6 p.m. each night as well. So
you know what,
thanks a lot.
If it bleeds, it leads, mate. So
that's it, 100%. So thanks a lot for your time, Chris, Cam. Appreciate it. Thank you.
no worries, mate. Thanks so much.
Cheers, Matt.